Okay, right. So because of long-term implications, we have to consider the time value of money, and because of capital expenditure, we also have to consider the relevant revenue and cost considerations. Okay, so whatever we evaluate must be relevant to that which we are evaluating. If it's we can't use something that is irrelevant to evaluate something that that like we can't really use an analysis of irrelevant factors when we are evaluating a capex or project or an investment. So these are the couple of basic factors that I looked at last week. What makes a cash flow relevant, future incremental, and it has to be a cash flow, literally a cash flow, which means I can simply adhere non-relevant. So what makes a cash flow non-relevant, or give me examples of non-relevant cash flows? Sunk costs, correct? Anything else?
Depreciation.
Okay, which is a non-cash flows. Depreciations, amortizations, provisions, bad debt provisions, any contingencies that you've put in place that are not material and not real cash flows yet. So non-cash flows, sure.
Does goodwill come?
Okay, goodwill. Yes, sure. For an investment appraisal, yes.
Fixed costs.
Okay, fixed cost, rather non-incremental. Something that doesn't change with the decision. Like for example, let's say, okay, it's a sunk cost, right? Fixed cost is, okay, let's say now, so I used to live for rent in Colombo, and uh, whether I stay or whether there's a month that I come home and I stay the entire month here, I have to pay the rent. It doesn't matter whether I stay there or whether the place is vacant, whether my friends use it, whether I'm literally, whether I'm just not using the place. It doesn't matter because it has to be paid. So uh, so in the decision of staying there and what I do with my life at that moment, the fixed cost, the rent is a fixed cost, and it's not really a relevant cost to whatever decision I want to make, because it is a commitment, and that leads us to committed costs. So this idea of and then this whole the way that rent example worked is, I'm not satisfied with it, but I hope you get the meaning. Sunk is what's already been paid. Committed is what you have already committed to, but you might not have paid it. But whatever you decide, it doesn't matter. You have to pay it. Like for example, um, let's say you have committed now you have committed to pay Icon a certain amount, and so whether you decide to sit for the paper or not, it doesn't matter. If you have already committed, if you have already, say, verbally or something, it can be a contract, it can be a legal document, it can be a simple verbal agreement, it can be a handshake agreement, it doesn't matter. But if you have committed to it, it's not a relevant cost to whether the decision of whether you will write the paper or not. Regardless of whether you write or not, you will have to make the payment. So these are some examples, right, for a cash flow to become non-relevant, and as a result, which move out of the purview of whether we use them when we do investment appraisal, right? So sure, fine, okay. With the basics covered, now we can look into the methods themselves. So the first one is ARR, right? Accounting rate of return, and it is the return on investment, the ROI equivalent. When you look at the formula itself, it is just an ROI equivalent which is annualized also. So you call it You can even have there is a version called the annual rate of return also, and some people call that ARR. So this one we call it accounting or accountant's rate of return, because this is something that is based on the accountant's numbers. Average annual profits before interest and tax divided by the initial capital cost, or alternatively, average annual profits before interest and tax divided by average capital investment, where the average capital investment is initial investment plus residual value divided by 2. So average annual profits before interest and tax, basically, even if it's a long term project, 5-year project, you will divide it by 5 years and get the annual profit divided by the mm, either this, but if you divide it by the capital cost, you can call it ROI, the return on investment, net profit over investment capital. Simple equation. Decision criteria is compare the ROCE to the target return, and if it is larger than the target, the project should be accepted. So you have to establish a target return. So if you're investing in something, and this is a number that you will hear about a lot, if you work in the investment side, and if you have investment, either now, I used to be in a investment banking space, and ROI is something that a lot of people, even when they invest in shares, think about what is my return on investment. So to decide whether it's good or bad, they will establish a target return, something that is subjective to themselves. So that can be varied. There is no exact science to develop the target return. And whatever your ROC, if it's larger than the target, project is accepted. Less than the target. Now, sometimes banks, when you go to banks and you ask for loans, let's say you have an investment plan, you want to start a business, so they will ask for the business plan to assess your credit worthiness and the project's credit worthiness. And within the business plan, an investment appraisal has been done, and they will look at the ROI, and they will look at if the ROI can sustain the interest payment they are expecting. And if their criteria to the ROI target and the interest, your ability to pay that interest is satisfied, only they will decide, okay, we'll give you the loan, we'll approve the loan. So it is an important number. Ensure you know how the target return has been calculated, initial or average basis, to make a like for like comparison. Mm, Advantages and disadvantages. I hope you've gone through this. Simple, widely used and accepted, like I said, considers the entire life, but ignores the time value of money. Not a measure of absolute profitability. It is a percentage, so we don't get the absolute figure, whether we are making, how much money we are making. Does not consider cash flows. That is why we call it the accountant's ROI, accountant's rate of return. Uses subjective accounting profits, which include depreciation, and so not only depreciation, but by various means it can be manipulated if you really know your way around IFRSs, and you can really just fool around with them. So do you guys want to take this down? Hello?
Yes, sir.
Yes, sir.
அப்ப சொல்லுங்க please. Then I'll leave it, no? 2 minutes.
the answer.
But these are very simple stuff, right?
Yeah.
Okay. So can you guys quickly give me the answer for this, or tell me the answer?
36% for the A.
Okay.
And 60%. That's what I got.
What about the others? Do you guys want to see the answers, or anybody wants a minute to quickly do the numbers? No, all good.
So could you show us the answer?
Yeah. There you go.
Oh, that's what I got.
How did I get the other one?
I got 9% and 15%.
Wait, did you say 30%, Krishna?
Yeah.
So,
Did you like forget to reduce depreciation?
Yusra must be like dancing.
So this is such a simple question, you can't get it wrong.
No, it's not. It's an important question. No question is simple.
No. I know
This
where
is
I
like
meant.
1 in a billion for Rushda, so nothing to be proud of.
So, it's not.
No, I didn't divide the number of years to get the average profits.
Average as in annual profit. You didn't annualize it.
Yes. Yeah, I didn't annualize it. Exactly.
Kaushika. Kaushika.
Yes, sir.
Are you sleeping?
No, sir.
Did you do this sum?
Yes, sir.
All good?
Yeah, I got the answer.
Okay. Question number 2. What about that? Who wants to see the answer? Anybody wants
Could
a
you show us
minute?
the answer?
Ashwant. தூங்கிட்டானா? Do you want to see the answer?
Yes, sir.
There we go. Okay, all good, yeah? Okay, moving on. Right, accounting profits versus relevant cash flows. So here, this is that discussion on relevancy of cash flow. So you can go through that. I'm not going to do this sum. Wait, did you try this? Which of these items are relevant cash flows? So quickly tell me. Market research cost 50,000. Yes or no?
No.
No,
Why?
because it's a sunk cost.
Okay. Purchase of an asset would cost 95,000.
Relevant.
Sorry.
Yes.
Sale of the asset at the end of the project for 10,000.
Yes.
Okay. Depreciation.
No.
Revenue per annum.
Yes.
Variable cost.
Yes.
Factory fixed cost per year that will rise to 21,000.
Only the incremental part.
So 18,000 to 21,000 here. What's the relevant cost?
3,000.
3,000.
Okay. Apportioned head office cost of $2 representing the project share.
Yes.
Relevant.
Really?
Representing the project share. For existing head of.
What?
Oh, not
Yusra?
But I consider it a relevant cost.
Arsan, do you have any opinions here? ஆளும் தூங்கிட்டானா? Day. Sorry, that is that you know the candy Azman coming out. Day. No, this guy is not responding.
Maybe you should try giving him a call to wake up.
Okay. Maybe I'm being too kind with the recordings. Maybe I shouldn't give the recordings. Are you getting recordings with all the sessions?
Yeah,
Then I have
I'm getting for one other subject.
Okay. Then yes, then we'll continue despite the problem with the cloud space. Proportioned head office cost of $2 per unit. This is not relevant, huh?
Why
Because
not?
it's an existing fixed cost that has been apportioned. Overhead absorption and apportionment. Remember, you come up with some basis to just spread the cost. So that's what you call an apportioned overhead. But ideally, the total cost doesn't change. They have to specifically tell us that something is going to change because of this project. If not, it's not relevant. So apportioned costs are not relevant if they are simply apportioned, right? Apportioned, allocated, reapportioned, none of those are relevant. Okay, so which of these items are relevant cash flows? Here you go. If I'll give you a minute with this. Any comments that don't make sense? Anything that you don't understand, please let me know. Done? I actually would suggest, because I went through your papers and you have detailed, like not recently, but a couple of weeks ago, I was going through your papers and I saw there are investment appraisal questions. So in the question, you get this information. You get, they give you all this kind of information, and one definite skill you should have is to filter out the relevant costs from the total information set that you get. So it is a very important skill, and that is why the reasons are important, rather than just knowing the whether the cost, or just knowing it intuitively. You have to know the reason, so you make it a habit to look for the reason. Done?
Yes, sir.
Okay, right. Okay, so right. So first, let's start with payback. No, we looked at the first one, ARR. If you go through, if you have gone through my tute and I asked you to go through it, I did also ask you to try out the sums here. You would have done the reading, so payback is simply the idea of how long it's going to take for you to get your money back. And you can have a target payback. And if you're getting the money sooner than that, you're good. But if you're not, if it's getting delayed and later, then it can be a problematic situation. In which case you might have to reevaluate things and decide, okay, I'm not getting my money by the time that I want it. So is it really worth it? And you have to, it doesn't mean that you reject a project, but it means that you are cautious about it. So the decision criteria compare the payback period to the company's target return time. And if the payback is quicker, the project should be accepted. Faced with mutually exclusive projects, choose the project with the quickest payback. Okay, so did you all try this sum?
Yes, sir.
Can we see the answer?
Yeah, everybody tried it. Anybody wants a minute? No, all good. Okay, there we go. Okay, all right. So then now this, of course, this is very easy because you see an annuity, no? You call this an annuity. You're making the same amount of money every year. So if it's an annuity calculation, annuity related investment, or an investment with an annuity method of annuity form of returns, you simply have to take the initial capital investment divided by the equal annual installment to get your payback period. Right? So if you want to, you can write that formula down. You can say payback yeah payback period is equal to when return is in the form of an annuity, the payback period is equal to initial investment divided by equal annuity, right? Equal annual return. That is what you see here. 2 million divided by 600,000. Then you can have situations like this.
So what's the formula again?
Sorry? Payback period, when the return is in the form of an annuity, that is, you're making the same amount of money every year. Simple. Initial investment. So in this case, we got 2 million, which is the initial capital investment. 123 divided by 600,000. can only be used when you're making an equal return. If not, you have to do it in the tabular format, or if it makes, if you can do it in your head, sure. Yeah. All right. Okay. Sorry. Right. Okay. I should switch off my phone. Okay. Question number 5, payback. It requires an initial investment 1 million. In addition, at the end of the 6-year project, the assets initially purchased will be sold for 200,000. So there's a 200,000 here also. End of the 6th year, there's a 200,000 that is another inflow. Yeah. So it's actually total inflow in the year 6 is 250, not just 50. Determine the project's payback. Did you all calculate it? What's the answer?
Years and 10.3 or 11 months.
Yeah, round it off to the forward figure. So if it's 10.3, you can say 11 months.
11 months.
Yeah. Everybody else agrees? Yeah.
So what's your answer?
Yeah.
Like my answer. Shall I show the answer?
Oh, okay.
Ashwat, what did you get? Ashwat?
I got 3 point something. Wait.
Okay, 3 point something, but the point figure, did you convert it into months?
No, sir.
So that point, get the decimal, like what we did here. Get that decimal, 3.33. So get that decimal and multiply by 12.
Number, yeah, 12.
If you want, you can multiply it by 365 and get the exact number of days. But we usually go with years and months. Yeah, okay, here we go. So it's 3 years, correct, right? 3 years, and so this is the table. I told you we might have to go with the tabular approach, especially if it's not an annuity. So then what happens is, ideally, okay, what happens is ideally, right, you start with this. We've already talked about the timeline, and it's very important to get the timeline correct. you will notice that year 6 has a 250. Even though these basic stuff, it's very critical, very important. You write the 200 in a different place, everything can go a little off the track. So here, cash flow, cumulative cash flow. So simple zero, you start with a minus 1,000. Year 1, you get 400. So this minus 1,000, net of this minus 1,000 and 400, you get 600. Then net of 600 with this inflow of 250, 350. Net of minus 315 and 200 minus 150, and you realize, okay, somewhere during the 4th year, you're making more money and you have recovered your money. So you know by this time, this final year where you have a negative cash flow is the number of years. And somewhere during the next year, so 3 years, and somewhere during the next year, you've recovered your money. How much to recover? 150. Total, you're making 175 during that year. So 150 over 175 will give you the decimal. Into 12 months, you get the number of months. So 3 years and 11 months, always round of the month.
It has to be 10 months, not 11.
Like round it upwards.
Yeah, I did. Still, like I get 10 months.
It's 10.3.
10.3.
It has to be 10 months.
It is 10.3.
Yeah, I know.
So why do you keep insisting that it's 10?
You have to round it up, no? That's what they have done.
Yeah, so rounding it up is up, not going down. 10.3 becomes 11.
Ah, okay.
Yeah, I love this. You know, I love this. Sometimes I feel like really, like we can really. I would really love it if we continue on this momentum of where we all exchange our ideas, and actually, if it's very easy, if Rushda can communicate to Yusra and Yusra can communicate to Ashwan, and and so on and so forth. So here we go.
In that exact order. No, seriously, like there has to be a reason. No? They just say Rushda to Yusra and Yusra to Ashwan.
So advantages and disadvantages of payback. Simple to calculate and evaluate. I've also, I've given you the tube. So, this is my version of things, but you will find the same stuff here. One of the simplest evaluation techniques helps companies improve liquidity by favoring projects with early cash inflows. Payback helps to minimize risk. Longer the payback is, greater the risk. Uses the project cash flows instead of accounting profits, so more objective. Disadvantages. Cash flows after the payback period are not considered, and hence the overall project is not considered. Ignores the fact that all future cash flows cannot be directly compared, since value of cash flows differ over time. So time value is ignored. You will notice it here also. Ignores timings of the cash flows. So that is why we have discounted payback. It only helps to identify whether an initial investment is recovered, not how profitable the investment could be, may lead to excessive investments in the short-term projects. All right. So then we move on to discounted cash flow techniques. Time value of money is looked at, compounding and discounting is looked at. So it's good that we do a quick recap on future value and present value. But if you remember,
So can't we copy that down?
What?
The payback advantages and disadvantages that you
I
highlighted in
I
yellow.
thought since you have this tube, it would be okay. Shall I let you?
No, it's really simple in the other one. Yeah, that.
Okay.
Same as the one you gave in your tube.
Pretty much same as, but there is one useful in changing conditions. So that is one thing that I didn't see in my tube. All the other things are at risk. And yes, no definitive investment signal. We looked at it when we looked at the decision criteria, because you have to have a target payback, and your decision will be based on that. And therefore, the target is very subjective. For you, you might say, I want my money, like you might be a risk taker, and therefore you might be tolerant to a target payback of like 3 years. I am a very risk averse person. So I'm like, my target payback is 2 months. So it's very subjective, which creates this situation of not being able to have a definite signal of whether you accept or not. It's a personal decision. Arson, that was Arson, right?
Yeah, sir.
So I got your WhatsApp message. You're really pushing back on my holding on to these little gaps in the tute, huh?
To ask from like day one.
Yeah.
I want to ask this from day one. It's really annoying. Like soft copy and shit.
Like you want me to print it for you?
My point was like when the notes which you give, the Kaplan's notes, it doesn't come with these the notes, and maybe leave away the answers, this advantages and stuff. If you write separately, right? So it gets really confusing. Like when you want to refer.
Right. Okay. Sure. It is annoying. Yes. So writing down is also an issue.
I can write down, but like when referring to it, it's much more helpful in this way.
Okay.
Or maybe if there's answers and you don't want to like send it right after, before we do the questions, you at least after the end of the chapter, we could maybe submit it, right? If possible.
Sure. Right. Right. Look, to be really honest, it's not confidential or anything. I mean, why am I showing this to you? But one way I pick and choose what to give you and what not to is because then it's a way for me to pressurize you to write. Anyway, online sessions are a little tricky with respect to engagement, and I can't dictate and I can't get you to maintain a note like I do in the physical session. So this is one way I'm trying to use, and just get you to write things. Writing is important, and when you write things get clarified in your mind. So my initial suggestion is for you to start writing if you're not already doing so. So that is the compromise from your end. And I do respect you, voicing your opinion, and I like that. It's a good thing. So do start writing, and I will consider the other aspect and give you everything. Anyway, it's already there.
I finished copying it down.
Everyone done? Okay, moving on. So time value of money, I think we looked at the basics last week. This concept of future value and present value, this formula. So it is the compound interest logic that we use to convert the value of value of money between 2 points of time. And because we want to have we want to have a relative point to which that we can compare all cash flows against. That is why we have the present value. So we know, because whoever does the calculations from wherever they are in the world, if there's a 0.0, it's very easy to compare, to do everything. So we have that present value point, and everything else that is happening in the future can be a future value. And future value is very adaptable, and it changes, right? It changes depending on the point of time. The value of money 1 year down the line is very different to the value of money 1.5 years down the line. And it's very different to the value of money 5 years down the line. So that is future value. Present value is today. And the formula is this: present value is equal to future value divided by 1 over 1 plus r to the power n. Right? So here, money received or paid today is worth more than the same sum received or paid in the future. It has a time value. This occurs for 3 reasons. Potential for earning interest. So the cost of finance is embedded there. The impact of inflation is embedded there. And the effect of risk. So discounted cash flow techniques take account of the time value of money when appraising investments. And the formula is given to you: future value is equal to present value into 1 plus r to the power n. So we'll start with a basic calculation. And also, did anybody check? Do you get the present value table in your exam?
Yes, sir.
You get it, no?
Yeah.
Do you have it with you?
No, I had to Google it yesterday when I was doing the sum.
Okay, so I'm sharing the present value table now with you. Okay, I just sent it over chat. Just download it and keep it on your desktop. Whenever you want it, you can open it and use it. So the present value table, the equation works in a very different sense, right? It's the reverse of compounding. If compounding is present value, compounding is this: present value into 1 plus r to the power n. So if you make the present value the subject, this is discounting. So this is compounding, and this is discounting. That is reverse compounding. And so what we do is we keep on changing this to say present value is equal to future value into.
I don't think it's provided.
Yeah, because like it wasn't there in the past papers that I
Yes,
got from
2018.
Sajani.
Yeah, 18, 19, it's not there.
Okay. So
It's really
previous ones, they are
inconvenient
there.
because
Previous papers, they are there.
But the recent papers, it's not there now.
shouldn't they usually like give it?
They should.
You know, in the 2017, they have stated that the present value tables are given, but from 18, it's not available.
Okay, so one thing is, it's very likely that given the current situation of the world, you might get a take-home assignment, paper.
Yeah.
So anyway, you can use it. And maybe, so do the research. Let's not get ahead of ourselves. See if they separately give it to you, you know. So there might be, they might be giving it to you without the paper, you know, separately. When you walk into the exam, you might have, just like your user, whatever exam number is on the table, you might have the PV tables printed out for you as well. Some exams operate that way. So maybe that's the case, but let's do the research and see if it's there or not. And then we'll deal with it accordingly. Okay, so here what you see is present value is equal to future value or divided by 1 plus r to the power n. What I did was I separated this fraction of 1 divided by 1 plus r to the power n, and now I call it present value is equal to future value into discounting factor. Therefore, the discounting factor is equal to 1 divided by 1 plus r to the power n. Can you all please take this down, this sequence of things? And the PV table that I just shared with you, the PV table, right? The discounting factor table or the PV table is a table of DCFs, discounting factors, for up to 20% for 20 years. So this number, this DCF is what you get. If you know the percentage and if you know the number of years, you can just look it up in the table and substitute that number here to the formula, multiply it by the future value, get your present value. If not, you can go ahead with this 1 divided by 1 plus percentage to the power n number of years and get your answer. Either way is fine. Okay, is good. So let me just try this as an example, right? Let's say we have a situation where I want to calculate the discounting factor for years 1, 2, and 3 at 10%. Okay, let's do it for 2 percentages, 9% and 10%, right? So if I do want to calculate it, so no. All right, there we go. Okay, so so then the formula is 1 divided by 1 plus R. R is 9%. Okay, to the power n. N is this. Yeah. Okay, so 0.917, that's your discounting factor. Okay, so let me drag this for years 3, 0.842, 0.772. Let me look it up for 10%, right? 909826751. Now I want to see if these numbers are what we get in the present value table. Right? I know this must be boring stuff for some of you, but please bear with me. Okay, so if I open the present value table, present value tables, 9% and 10% years 1, 2, and 3. Let me take this. Let's see if it's the same. There we go. 917842772, 909826751. Yeah. So this is what the present value table means. There is another table called the cumulative present value table. Okay, this one, annuity table. So that is a shortcut for when we have annuities. We will also learn that here itself. Say, for example, what we can do is we can create a table if we have like loan installments where we are paying the same amount, same cash flow every year. We can directly go with a mode of, let me copy this here. This plus this. Okay, so as you can see, what happened was I keep adding the annuities, discounting factors for the cumulative value. So by year 2, the total discounting factor effect is 917 and 842. Year 3, 917, 842 and 772, 2.531. So if we check it for 10%, right, 909, 1.736 and 2.487. Let's see if it's the case in the cumulative present value table. 9% and 10% first 3 years. So that is the present value table. It's also known as the DCF table. So from the annuity table or the cumulative PV table. There we go. $917, okay, 1.759, okay, 2.531 done. 909, 1.736, 2.487. So this is how those two tables work. So you have to be very careful which number you use. Anyway, it's very easy to realize. In the PV table, all the numbers are less than 1 because you are discounting a single cash flow. But after the second year, third year in the annuity table, why the number is more than 1 is because you're discounting multiple of the same cash flow. So year 3, if you're applying this 2.531 to a certain cash flow, it means that you have made that particular cash flow at a 9% rate in year 1 and in year 2 and in year 3. So you can directly, instead of multiplying the cash flow individually by 917, 842 and 772 separately and then adding it, you can directly just say 2.531 into the cash flow is the present value of that form of cash movement. And this is how the tables work. So that idea is important. And it will kind of, you'll get the hang of it once you start using it. Okay, so first we can start with a compounding equation. Actually, I'd rather go to discounting. So discounting is the present value calculation. Here you go. What is the present value of 65,000 receivable in 6 years' time if the applicable interest rate is 7%? Those of you who've done it, can you give me the answer?
Is it 43,312.2?
65,000 receivable in 6 years' time. So if I also try and do the calculation, we know that present value is equal to future value into discounting factor. So future value is 65,000 into, I want the discounting factor at for 7%, no, 7%, right? Yeah, 7% in 6 years' time, 7% in 6 years' time. So what is the discounting factor, 7% in 6 years' time? %, 6 years' time. Go to the PV table. 7% 6 years' time is 7% 6 years' time. So 0.666. So it's 65,000 into 0.666. 43,290. Is that what you said, Yusra?
I said 43,312.
Okay, so here what happens is you would have noticed in the PV table, even though the decimals are very, there's a lot of decimals to work with, but we round it off to 3 decimals, and therefore there can be slight deviations. Now, say for example, if I do this, okay, if I go up to 8 decimals, and then if I go up to 8 decimals or 5 decimals here, you will realize the effect of this number is very different to a 3 decimal concern. Okay, so that is why there can be slight differences. That is not a issue at all. If you use the PV table, the examiner knows. If you use the formula, you have written it, the examiner knows that you have done the right thing. Either way is fine. We will see what the examiner, whether the examiner gives the PV table or not after Rushda clarifies it. All right, then finally, we can look at net present value. So when discounting so far, we have referred to the rate of interest, alternative terms to be used. So as we go forward, you will start seeing these words: cost of capital, discount rate, required return, interest rate, rate of return, etc. So all of this, all rate of interest, all of this are just different labels to the same word, that R, simple R. Okay, so we have a separate chapter called cost of capital, the weighted average cost of capital of a company, right? You weight the cost of debt and the cost of equity respectively with the weight of the equity and debt injection or the equity and debt mix of the company. So that is a specific discussion on the cost of capital, but ultimately cost of capital and required return are all interchangeable words for the same idea, that simple R you see in the discounting formula. Whichever term is used, the rate of interest used for discounting reflects the cost of finance that will be tied up in the investment. So now we have NPV, but before that, let's look at payback. Sorry, discounted payback. So what I want you to do is, in the payback method, in this calculation here, now you know how to get the discounted payback as well. You know the initial investment, etc. Can you tell me the DPB, discounted payback? I'll give you 5 minutes for this.
So what's this one?
Sorry. Let's say 12%.
So did you share the PV table?
In the chat, see if you haven't received it.
No, I haven't.
You did in the group chat. I received it there.
WhatsApp?
The WhatsApp, the Zoom chat. Do you want me to send it to a WhatsApp also?
It's not on WhatsApp.
It's not. Yeah.
Not on WhatsApp, on Zoom.
I didn't get it.
It's coming on WhatsApp now. There we go. Sent. Why didn't it arrive in the Zoom chat? I resent it again on the chat. See if you got it.
No, sir.
Nope.
WhatsApp?
Yes.
Yeah, we have it on WhatsApp.
Do you want me to email it, or can you get it to your PC?
On the chat. I got
No, it's there on WhatsApp, so it's fine.
Yeah, both.
So what's the difference between Arsan getting the PV table and you guys not on Zoom?
Maybe you sent it only to him. That's the only thing I could say.
Yusra, you don't need to say it that way.
What?
He has sent it to everyone. It's not
Maybe
specific.
Arsan's your new favorite student. That's why.
Yeah, I did send it to everyone. Look at this.
I haven't got it. Like I usually get
Yeah,
a
so I don't know
notification
if
or
it's
something. There's nothing.
See, PV tables from me to everyone. 11.4, 11.22. Favoritism is that the word favoritism or favoritism?
The second one. Favoritism.
That one, I'm not into it, you know.
Rushda and I think otherwise.
And who is my favorite?
Last year it was Sajani.
And what? Wait, this discussion has come up before. You guys saying something that I was very nice to her, and that I don't usually.
Yusra gets jealous, so it's okay. It happened now first year also when Deepta, our accounting lecturer.
Excuse me, Deepta? Shut up, Arsan. Don't even go there.
So this is Yusra's problem, right? Okay.
Yeah, basically.
Right. Okay, so let me also try this, no? So cash flow year 1, 2, 3, 4, 5, 6. Cash flow is 400, 250, 200. Sorry, 250, 200, 175, 75, 170. $50. Okay, but 50 plus 200, no? So 250. Then I can get my cumulative cash flow. 0 minus 1000. Yeah. Cumulative cash flow. But I need my discounting factor at 7%, at 12%. So I suppose what I'll have to do is 1 divided by 1 plus, I can get it from the PV table, 1 plus 12% to the power n. Okay, there we go. We have the present values. Then I get my present value. That is the future value multiplied by, or rather, present value of the individual cash flows. I'll have to multiply the individual cash flow. So I use this for payback. Payback is equal to 3 years and 11 months here. So I got my payback. I'm not going to use this for this calculation. So here, of course, this calculation is different. So I'm going to use this color. Right, okay.
So after discounting it, do you have to find the cumulative cash flow for the discounted cash flows?
Yes.
Okay.
So now I have the cash flows. then I have to calculate the cumulative present value cash flows, right? So this, whoa. So there's no payback, is it?
Yeah.
Right, all right. No payback at 12%. So you can get a situation like this. As you can see, what if I reduce my cash flow to, let's say, let's say 8%. So at 8%, check what the payback is. You did the 12%, sure, no payback at 12%. At 8%, what is it? It's definitely got to be how many years? A minimum of 5 years.
5 years and 6 months.
Right. So it's going to be discounted payback. 5 years. And what I will have to do is during the year, I get 157, but I need to break even. I need 76.85. So 76.85 divided by 157.54 into 12 months. That is how I get my payback. So this one, if I get this 5.85, therefore the discounted payback is 5 years, 6 months. Correct. So this is how you look or get the payback. This is how you get the discounted payback, the cumulative present value approach. Yeah, all good. Okay, right. So you have your answer for discounted payback. If you look at okay. So the only difference in payback and discounted payback is in discounted payback, this disadvantage, right? This disadvantage is now addressed, and therefore in DPB, time value of money is considered. And DPB is almost always or always longer than PB. Right? Discounted payback is always longer than payback. On that note, I think we can move to the next approach, which is net present value. So with NPV, what happens is you discount all the relevant cash flows for a project back to their present value terms, with cash outflows as negative and cash inflows as positive. Add up all the present values to determine the NPV. So NPV is just the addition of all the present value figures you have. So in this project, whatever that calculation we did, the NPV is simply this sum of all this. You will notice the NPV at 12% is minus 20. The NPV is at NPV at 8% is 8. Why is NPV decreasing when your cost of capital is increasing? For the above project, 8% and 12%, the rate NPV cost of capital, NPV is for 8% 80, for 12% minus 20. Okay. Let me even go a little step further. Let me see what happens at 5%. Let me see what happens at 18%. So at 5%, so that is at 5%. Are we serious? Okay. So at 5%, it's minus 2.62. Okay, 169.77. 18%. So this is at 5%. Let me calculate for 18%. So I have to make this 18 and it was E, right? And this I have to make it, the cash flow was here. Okay, all right. Minus 144. So if I just try to gauge how this moves, if I draw a chart, there we go. NPV and cost of capital.
So we're not trying to find IRR in this case now?
Sorry?
We're not trying to find the IRR now, right?
I'm not trying to find the IRR, but I am trying to kind of discuss the, the kind of situation. Okay, so we'll go with this. So as you can see, why, my question is this, why is your NPV decreasing when your cost of capital is increasing? Yeah, that's my question.
Does it have something to do with inflation?
Inflation?
Yeah.
Ashwant?
So is it because your cash flows are getting higher throughout the years at a later date compared to at the beginning? So because the
Cash
rates
flows actually go down, it decreases.
reduces, and when you multiply and see the amounts, the present value amounts get lower by date, and your cash flows increase only later, not in the first few years, right?
Okay, so let me get the cash flows also here.
So can't you say that your project loses value as inflation increases? The real value of your cash flows reduce, yes.
So you have the NPV figures also now. All right. So project loses value. Ashwant, you were saying something. I heard Arsan's answer. Ashwant, what about you? And Arsan, about the cash flows don't change. Cash flows are the same. Is that right? Because the cash flows don't change. You know, you're getting the same amount of money.
No, I have something in mind. I really don't understand how to put it out in words. It's okay.
Which is why you should try, you know. It's very important. Rushda, you're waiting till everybody else tries, is it?
Yeah.
Yusra, you can't just let this go, you know, this type of behavior.
What? I wasn't paying attention.
Can you give it another shot? Kaushik, are you? Do you have any opinions about this? Did you even understand what happened here?
Is this something to do with the return of the project? So cost of capital is basically, it's like the cost, an implicit cost. So the higher the cost, the return that you gain from the project is lower. Does that happen?
Okay, sure. Kaushika?
Shareholder value decrease.
Okay. Kaushika? Did you understand what happened here? I calculated the NPV for different costs of capital.
Yes.
Are you sure?
Yeah.
And did you notice that with when the cost of capital is increasing, NPV is decreasing?
Yes.
Yeah. Okay. Okay.
So the higher the discount factor results the lower NPV, right?
Yes.
So is that the reason?
Mathematically correct. Yes. Agreed. I'm trying to see if you have any financial and you know, sort of any ideas as to why it happens. And the answer has already been shared, and I think all of you share the correct opinion also. And even Arsan, what he said, I get what he tries to mean. So it's okay. But Arsan, I would really like it if you give it another shot. No? Okay. Even what Yusra said is correct, you know. So the thing is this, with your cost of capital, right? The money isn't free. Investments aren't free. So if you're committing a certain amount of capital to a certain project, in this case, this particular project where you're making a certain amount of money over the years, which has a payback of 3 years and 11 months, which has at 8%, it has a discounted payback of 5 years. At 12%, it doesn't have a payback at all, at least for the project's lifetime. So what happens is that in time, as also Rushda mentioned, what you notice is with the cost of capital, because money isn't free, you have to bear this cost. Whatever the cost of capital is, you have to bear it. If the lender, if it's a bank that has given you the complete 1 million here that you see, then you have to pay the interest. And what you see as the cost of capital, the 8% and the 12% is their interest rate. You have to service them. If it's equity owners or shareholders, they will take their money in terms of dividends. So if we are assuming a number to say the cost of capital or the cost of equity in such a case where the entire 1 million is coming from owners, then the rate of return they expect is implied by this cost of capital, by this percentage. So this is why, as the commitment to our lenders from the debt side or the equity owners from the equity side, as the commitment is higher and greater, if we have to give them more, the return of the project is less. What is left of the project is less. And this is very, very simple idea. You notice in your in any projects that you do in your P&L, you have your revenue. Okay, then you have your gross profit. You deduct your gross profit. Then your operating costs, or rather cost of sales, then operating costs. Correct. Then you end up with your operating cost. Operating profit. From the operating profit, you deduct your finance cost. So now what are you left with? You're left with PBT, profit before tax. So what will happen is, if the finance cost is greater, if you have to service more, this will become less. So this is a 1 year view in the P&L, the profit and loss statement. The more you spend here, the lesser you will make here. That is what is implied here. The more we have to service our debtors or the equity owners, the lesser the project will make. And it could go up to a certain extent where the project is not worthwhile at all, because you might not generate, in present value terms, you're not recovering what you're spending. So in all the cases after this point, right, in all the cases where NPV, this blue line is below the NPV 0 line, below the x-axis, below the x-axis, this entire space means that the project's return. Okay, let me bring it here. So from this point onwards, it simply means that the project returns are less than the initial investment made. Okay. Right. So here, of course, you have a positive NPV. And that brings me to what Arsan was asking me about. So another way to figure out whether a project is worthwhile or not is by looking at this point, this exact point where what do we call this? This point where NPV is 0.
IRR.
Internal rate of return.
Okay, internal rate of return, right? So internal rate of return. Sure. And what does that imply?
Maximum rate that the company could go to or afford to, then the cost of capital is.
Okay. Right. So internal rate of return is graphically the cost of capital where NPV is equal to 0. Sorry, NPV is equal to 0, right? And there is a explicit definition to it. So now we can go back to our topic here, IRR. There we go. So the IRR represents the discount rate at which the NPV of an investment is 0. Okay. So here the IRR is at this point that I marked. The IRR where the NPV is 0. What does this mean? Project should be accepted if the IRR is greater than the cost of capital. The IRR is calculated using linear interpolation. You can use differential maths for this, but we just learned the two, what do you call it? Congruency of triangles is the logic that is used here. So calculate two NPVs for a project at two different costs of capital. Use the following formula to find the IRR. IRR is equal to L plus NL over this formula, where L is the lower discount rate, H is the higher discount rate, NL is NPV at the lower discount rate, NH is the NPV at the higher discount rate. So technically, based on this information that I have calculated here, if I try to substitute the values, I'll go with 5% and no, I'll go with 8% and 12%. So L would be the 8%. 8%, 80, 12% minus 20. NL is 80, right? So NL is 80 minus 20. That is this. This is this. And H minus L is H is 12% minus 8%. So can you do the calculation and tell me what the IRR is of these numbers? And we'll see if graphically it matches in the chart. And use that as an opportunity to write the equation also.
Is it 11.2%?
Probably. We'll wait for another answer. Anybody else?
11.2.
Okay, 11.2. There we go. Kaushika, did you get 11.2?
Got it, sir.
No?
I got it.
You got it. Okay. So that is how you calculate the IRR mathematically. And if we check the chart, yeah, no, seems like it's 11.2. Right? Not bad. I can actually extend the chart to show even more decimals, and I am sure 11 will be somewhere here. So all good. The IRR is 11.2%. Okay. So when it comes to the IRR, there is an example which you can try. Blah, blah, blah. Okay. So in the tute, right? In my tute, in the tute I have given to you advantages of IRR. It is easily understood by the non-finance managers. That is, the project earns a yield of 25% as against the target yield of 15%. Is more understandable as against an NPV of 50,000. So that idea that we get a percentage answer for IRR instead of an absolute figure is something that is very positive. And when you tell a manager to say, look, our IRR is 10%, our cost of capital is 6%. So let's go ahead with this. They understand that more than looking at an absolute figure if they don't have a great idea about the numbers. It avoids the identification of a discount rate, which is complicated for many years ahead with factors like inflation and uncertainty. Now, one of the biggest problems with now I asked you to calculate the rates. No, I asked you to calculate the NPV for different rates, right? 5%, 12%, 18%, 8%. And what guarantee can you give me that whatever you finalize, finally here, right? Is it 8%? Is it going to stay 8% for the entire? It's a 6-year project, right? And if we have a complicated capital structure with a moving mix of debt and a moving mix of equity, this number won't stay the same. And that means today we can have an 8% situation where our finance cost, we might have the same lender, same bank, but 2 years down the line, we might restructure our loans. And then the restructuring could lead to a higher interest rate. And if that is the case, we might have to ideally end up with a bigger rate of return to commit to the bank. Now, if that is the issue, if that situation happens, it means that our cost of capital is a moving number across the entire lifetime of the project. So, this certainty of the cost of capital, right? The extent to which we can really rely on this number is a disadvantage with payback and NPV techniques overall. Disadvantages, the relative size is ignored. So you can have the same IRR, say 10%, for a project which takes up 5 million, as opposed to a project that takes up 5 trillion. Same IRR. So scope-wise comparing can be difficult. And when discount rates are expected to differ over the life of the project, it cannot be incorporated to IRR like in NPV. Right? That is what I discussed here as well. So, so actually what happens is that the fact that you don't have to identify a discount rate can be a positive thing, but it can also be a negative issue because your IRR is only one, but you can calculate NPV like we did here for different rates of interest. So NPV gives us that flexibility to say, okay, every year we can do a different calculation and get an updated figure and see if we are okay. So that's with NPV and IRR. I suppose now it's just getting used to some of the numbers and some different kinds of calculations until you get a hang of things. But before that, I suggest we take a break. Yeah. So we've been going on for a couple of hours now. Must be tired. We'll take a 15-minute break, 11:58. I'll see you at 12:15, guys. Okay.
Okay.
Sir, do you have the answers for the questions you gave in your tute?
Answers for this one? I don't have the answers. We can try them.
All right.
Yeah. Just let me know if there's a specific question you want me to try. Now, I paused it during the break. 6.811. So which is, as you can see, it's 810, but when you round it off to the third decimal, you get 6.811. So we have the final answer, 39,503. So you can either choose the longer route of using DCF for individual years, but ideally we bring that down to method 2, which is directly using the annuity factor equation. Here I have used the equation. You can check the equation application here on Excel, and or you can use the third method directly, but this is only limited for a limited time period, as in for 1 to 20. N equals 1 to 20. For when N equals 1 to 20, we can use the annuity table up to 20%. And that too only whole numbers. If you have a decimal figure like 15.2%, 8.3%, you can't use the PV table. Okay, you will have to use the equation. That would be the easiest approach. And as such, this is what we call an annuity. Right. So by looking at this, can someone explain to me what an annuity is? Therefore, an annuity is what?
A constant cash flow.
It is a
Constant cash flow.
A constant, yes, equal. See, if the cash flows are unequal, you won't have a common factor to multiply. No, you can't, because it's equal. Every year it's equal, right? And constant, correct. Periodic, most commonly annual, right? It has to be regular, right? Cash flow, it can be an inflow or an outflow, and that is what we mean by an annuity. Okay. Now, then comes the question, what if somebody tells you, that is okay, done. Someone tells you that you will receive an amount of 10,000 USD per annum forever. Now what will happen? Calculate the PV, rate of return. So you deposit this in a bank account, and the bank account pays an interest, or the rate of return from the bank that you get is, let's say, 8%. Calculate the present value. of this forever benefit? How would you go about this? Isn't this an annuity?
No,
Yes,
it's
but for a
perpetuity.
perpetuity.
Yes, it is an annuity. It has the same behavior. It is an equal, constant, regular cash flow, yes. But the difference between an annuity is for a limited and known time period. So you know for how long you will get the uh, account, you know how for how long the annuity is received for. But with some situations, you don't know up to how long, how many years you will get this. So that's why forever would be a very tricky word to use. Nobody even lives forever. So, you know, it's a like all these, like for example, this 99-year leases, like you know that the Port City project, there's a 99-year lease. Like anything and everything that we have worked out with China has a 99-year or a forever kind of situation. So you know how that word interchangeably addresses things. So that's the thing, you know, that's the problem. So how do you calculate the present value of this sort of situation? What is the present value?
So 125,000, right?
125,000. Any other answers? But how?
10,000 divided by 8%.
Yeah, 125. The
So
future value divided by the rate.
divided by 8%, is it?
Yes.
How? Why? Yeah, how does this work? Hello?
Don't know.
You know the answer, but you don't know how you got there?
We know the formula, but we don't know how the formula came about.
Ah, okay. You know how the formula came about. How did the formula come about?
Don't know how the formula came about.
All right. Okay. So this is the thing. This is also an annuity. So same logic applies. Okay. The same logic applies. What will happen is you will have the cash flow year 1 to forever, right? That's your year. Cash flow, we don't have a zero, no? So let me say 0 is 0, right? Cash flow is 10,000 rupees you're getting every year. Then annuity factor at 8% forever. Okay, you have to figure that out. Then you get, so there is nothing here. Okay, year 0, annuity factor is always 1. Present value, and then whatever total you get, you can call it the net present value. Okay, so I'll just quickly explain to you what happens here. There's a small adjustment to annuity factor. When this becomes forever, n will become very large, correct?
Yeah.
Yeah.
So when the power becomes very, very large, you know this.
Oh, it's infinity.
This entire figure becomes extremely large. Sorry, when it's actually, this is how it works. The actual formula is 1 over r minus 1 over r into 1 plus r to the power n. Okay, this is the annuity factor formula. When n becomes very big, what happens to the denominator? When the power becomes
Becomes
very, very big, the entire denominator becomes
Very big.
yes, right? Becomes massive. And when you divide 1 by a very large number, what happens to this entire thing?
It's closer to 0. Yes.
Closes into 0, right? We call it tends to 0. It tends to 0.
Tends to
It
0.
is not 0, but 1 divided by infinity is it tends to 0. So because tending to 0 is implied to be very small and negligible, what happens is in this formula, this whole thing gets cancelled off. And so the annuity factor for 8% forever is simply 1 divided by R. One divided by R. That's the formula. So this gets cancelled. Okay. And that is what brings us to a factor called the perpetuity factor. The perpetuity factor is 1 over R. And therefore 1 over R is 1 divided by 8% is 12.5. Therefore the present value is 10,000 into 12.5, 125,000. Therefore this is 0. Therefore the net present value is 125,000. There you go, you have your final answer. Okay. Right. Now, then you can help me out by telling me, what does a perpetuity mean? Therefore, a perpetuity is what? An annuity
For an unknown.
it works in the same logic, but the time period is unknown. So we assume it's forever. Okay. And those are the 3 forms of cash flows that we usually work with. Individual cash flows, annual cash flows, annuity for a known time period, and annual cash flows forever. So now let me give you a sum. Let's say an investment requires initial capital of 20 million rupees, 20 million USD. Okay. The first 3 years cash flows are respectively 5 million, 7 million, and 20, and let's say 10 million. Okay, I'm gonna make this 200. From year 4 to year 14, no, year 4 to year 15, annual regular cash flows of 2.5 million is made, right? Then year 16 onwards, 0.1 million cash flow forever is assumed. Calculate the present value NPV of this investment. Okay. If the rate of return is 7%. An investment requires capital of 200 million. First 3 years, 5 million, 7 million, and 10 million. 4 to 15, let's make it annual regular cash flows. No, I'll make this 12.5. Year 16 onwards, 0.1 million cash flow forever is assumed. Calculate the NPV of this investment at 7%. You have to be very careful. There are things to, I can, another capital injection is made at the beginning of the 10th year for 18 million USD. Okay, so initial investment is 200 million. Beginning of year 10, there's another 18 million that goes in. From year 4 to 15, sure. First 3 years, sure. 16, sure. Calculate the NPV. There we go. How many minutes? Rushda, I need a favor.
Yeah, sir.
Here, can you roughly send me, I think I have, but I want to cross check. Roughly send me the dates that we had the sessions with the rough timings.
Oh, okay, sir.
Yeah. I only remember a few. Just so it'll be a big favor, please.
The sessions we had already.
Yeah.
Oh, okay, sir.
Yeah. Okay.
Okay.
Thank you.
So what's the answer? I got 71.4.
Anybody else?
I got a negative NPV.
What? Can't be, no.
So I also got negative. It's minus 71 point.
I got -2.
I got negative 104.
I got negative 94.89 something.
This is what we need. This is exactly what we need. So many NPVs. Anybody else? Kaushika. So we'll have a small competition. Rushda, what did you get?
104.6 negative.
Negative. Ashwant?
Minus 71.4.
How the hell are these deviations? -2, is it?
No, minus 94.9.
Kaushika? I can't believe that you guys are making me do these sums, huh? I had given up on this stuff years ago. Kaushika, are you working on this?
Yes, sir. Still doing.
Okay. Take your time. Arasan?
So I'm stuck at the middle.
Okay.
Annuity.
Okay. Then I'll also slowly start working on it. Let me get this here. I have to reduce the scroll. All right. Okay. So, here, cash flow, discounting factor or annuity factor or perpetuity factor, right? All at 8%. Sorry, at 7%. Present value, and then we'll net it off at present. And okay. So here 0. Cash flow is 200 million USD.
So I want to change my answer.
அப்படியெல்லாம் chance கிடைக்காது.
No, 108.7.
8.7. Right. So this is, as you know, even if you apply the calculation, the DCF equation, if you put 0, n is 0, becomes 1, right? So present value, okay, we'll get to that later. Okay, I want to make this look slightly better. So I'm gonna just do a little bit of formatting. I hope you guys learn a little bit of Excel also, with the way I work. Okay. First 3 years, no? 1, 2, 3, right? 5 million, 7 million, and 10 million. So I will need my DCF figures. 7% DCF, 9.935, 0.935, 873, 816, 873, 816. Year 4 to 15 annual regular cash flow of 4 to 15 annual regular cash flow of 12.5. So this is an annuity. So what do? I go to the annuity factor table and use 7%, 15, 9.108. 7%, 15, 9.108. Right? Okay. Then another capital injection is made at the beginning of the 10th year. Beginning of the 10th year is which year? Like what is the year number? You have to write the N figure. 9.
9.
9.
Then I go back to 7% my DCF because it's an individual cash flow. 7% year 9 is 0.544. Okay, 7% year 9, 0.544 as you can see. So that here, then.
Can I alter my answer? Because I got minus 99.9 now. It's not a big difference.
Minus 99.9.
Mine is anyhow wrong. I know that.
Okay, right.
Oh yeah, but who cares?
So careful timing. Okay, I wanted to confuse you. Not 10, it's 9. Then year 16 onwards, 0.1 million cash flows forever. So 16 onwards. So it's a perpetuity. Cash flow is 0.1 million. Therefore, 1 divided by R, 1 divided by 7%. 14.285. Okay. Now, this is a minus, no? This 18 is a minus. So I get my present value. I simply multiply this by this. Make this bold. Okay, right. Moment of truth.
So I have a question.
Yeah, is the cash injection?
The
Is
16,
it...
no, not the cash injection. 16
Right.
onwards, how did you get 14, sir?
Okay, question number 1. How did I get this? Any other questions?
The cash injection, why do you take it as negative?
Because it's an outflow.
Negative.
No, but you're injecting it into the, so isn't it?
So 200 million is also an injection, no? I mean, incurring an additional cost.
Like it's an investment. You know, capital injection is investment.
Okay, my answer is wrong anyway. So.
No, that's okay. Right? And you think what you see here is correct. Even this is wrong. There are so many things that are wrong about this. That's why I'm asking you. What other questions do you have?
And the annuity factor also.
Okay.
I have my doubts on that.
Yeah?
Yeah, that. Yeah.
Any other questions?
And I didn't get, no, that's again. Okay.
What?
No, that 16 onwards is only a big issue for me.
This one?
But that, the 1.429.
No, 14.2857.
Yeah, that's an issue.
Why? What's the issue?
How did I get that? So what did I do there?
1 divided by 7%. 1 over R. Perpetuity factor. It's a
Don't you have to discount it to
exactly
16 years?
Okay.
Because even I did that and I got like 0.4839.
Okay.
Same thing, I got that.
Okay. So, yeah, any other questions? Anybody else?
And like the second, I think 4 to 15 years. So you multiply the cash flow by the annuity factor and you discount it by 4 years or
You don't
something?
discount that. Yeah, you don't.
Ashwant,
I don't know.
Yes,
speak.
nothing to say. I have looked at the wrong table. So yeah, that's my answer.
டேய், இதெல்லாம் எப்படிதான் நடக்குது? Why?
I don't know.
Arasan,
It's all Greek, sir. First time.
wait, is this what I have done so far? Is it Greek?
No. Like I'm saying forward.
Huh?
Forward. Like after these stuff. I get what you're doing.
You get what I'm doing, right?
And Yusra actually pointed out, I really don't understand how the minus also came over there.
This one?
Yeah.
Okay. So money that we are spending is minus. Okay. Right? Money we are getting, we are earning is positive, plus. So the 200 okay, the 200 right? The 200 is money that we are spending. It's our money we are spending on this project. So it's an outflow for us. 18 is also such. It's a capital injection. You're investing, you're putting money into it, you're spending. So those two are negative. Rest of it is money that is coming to us. The money that is being earned by the investment. So it's positive. Does that make sense? Yeah. Okay. Kaushika.
We will have the cash inflow.
Can you speak a little louder, please? Okay.
So don't we have the cash inflow in 9th year?
Don't we have the cash inflow in?
9th year, because we have the annuity, right?
This one?
Yeah.
It is in the 9th year, year 9, correct?
Yes. And also we have the...
Yeah, so
So
that's
it's the word injection that does it for everyone.
the word injection.
Yeah, that does it for everyone.
No, it has to be used because you're infusing capital, injecting capital, infusing capital. You will see these words, so you have to be familiar with this. Infusing, injecting, investing, all the same meaning. Right? So, no, I think Kaushika's problem is isn't there a cash flow in year 9? Okay, now what I'm going to do is I'm going to blow this up. Right? So instead of doing this, what I'm going to do is because this
So one more question, just one more question. Beginning of the 10th year is basically end of the 9th year, so that's why you take 9. Is that it?
Yes, yes. Yes, it is. Okay, cash flow. Okay, now what I'm going to do is I'm going to calculate 5, 7, 10, 12.5. Right. Here 16. So 4 to 16, I'm going to separate the cash inflows and outflows. Cash inflows, cash, sorry, let's put outflows here. And cash inflows here. Okay, right. 16. Right, okay. 200, 5, 7, 10, 12.5. So according to the calculation, what they say, okay, right. So 200 cash outflow. I'm injecting 200. There's another injection 10th year, beginning of the 10th year, which is synonymous for end of the 9th year. So there's another 18 here. These are the money investments, the capital investments I'm making. The returns I'm making year 5, year 7, year 10, 12.5 continuously. And here 0.1 million, right? Okay. Now let's calculate the discounting factors. Equals 1 divided by 1 plus R is 7% to the power N. So this will be, okay, right. So now I have the my present value also. Let me present value of inflows, present value of outflows, right? Okay. Now, is this correct? Is everybody clear with how I got the present values here?
Yeah.
200 into 1 and the 18, since it's happening at year 9, which is the beginning of year 10, 18 into 0.5439. It's the present value is today it's like spending 18 million in 9 years. It's like spending 9.791 millions today, right? Outflows, I'm getting 5 here. Okay, 4.6729. Let me leave the annuity. And if I sum up the annuity, okay, if I sum up the individual cash flows, sure. Okay. Now, if I add these two, this just the annuity, right? Just the year 9 to 4 to year 15 cash flows, I'm getting 81 million. Now, if I look at what I got here, 12.5 into 9.10, 113 million. Why is this wrong?
Because annuity factor you have to see from year 4 to 15, not from 1 to 15.
Right? So is everybody clear on that? The correct answer is this. This is the correct answer. 81 million is the value of the 12.5 you're making from year 4 to 15, not year 0. If I just take the annuity factor of year 15, here 9.1080, it's wrong because I'm assuming I'm making money from year 0 itself. So year 1, year 2, year 3, year 4, year 5, etc. I'm making so much money. But the initial cash flows here, the first 3 years, I'm not making any money. So technically, when I'm using the annuity factor method, what I should do is, it should be annuity factor of year 15 minus annuity factor of year what?
3.
3, right? Because as you can see, 5, 7, and 10. The first 3 years, I'm not getting the 12.5. So those 3 have to be removed. these three will have to be removed. Okay, so ideally what is happening is 9.1080. To get the right answer, I have to deduct the cumulative present value of 7% year 3, 2.624. Now when I do that, I should get a close answer to that 81 million I got here, 81.045045. Let's see if I get it. There we go. 81.050. 81 point, don't care too much about the decimal. I got this from the table. So annuity factor of year 15 minus annuity factor of year 3. 9.108 minus 2.624, because I have to discount this. You will notice my deduction 2.624 is close to the sum of these three.
So could you repeat why it's 3 and not 4?
Because 12.5 is beginning from year 4. So only 3 years, year 1, year 2, and year 3. Only these 3 years are not included, which means these are the 3 numbers that are not included. This what you see in orange. So if I add it, let's see if I 2.624, year 3, I have to exclude these 3 figures because these 3 are not related to the annuity.
Oh, okay, I got it.
Yeah, and that sum is 2.624. Now finally this is correct, 81.05. Now why is this wrong?
Not that's the other one. You need to present value it, discount it to the 16th year.
But this one?
Yeah.
That's okay. But 1.429, you need to discount it.
Okay. Any other thoughts, Kaushika? I'm telling you this is wrong. Why is this wrong? The hint is already given here. Ashwant? Ashwant?
Yeah, so, yeah.
Why is this wrong?
I don't know.
Okay. Now, if I use 1 over R, like what I have done here, perpetuity factor, 1 divided by R, see, 1 divided by R. Okay. What is the time period I'm thinking?
Oh, 1 to forever.
1 to forever. But this sum I gave you, is it 1 to forever?
No, it's 16 to forever.
16 to forever.
16 to forever. Which means there's a 1 to 16, or rather it's starting from 16, then 1 to 15 I'm not making. Like here, the 1 to 3 I didn't make for the annuity. For this, I had to exclude the first 3 years. Similarly, I have to exclude the 1 to 15 from this, correct?
Yeah.
So
How do you do that?
So what I will do is add perpetuity factor of 14.7% discounted to the value of year 16 discounted to today or present. So what I have to do is, ideally, therefore, perpetuity factor of 7% multiplied by DCF year 15, because I have to discount it back to year 0. So 14.2857 into what is the discounting factor year 15? Of 7%, 0.362. By doing so, the 1.429 will be brought back to its present value terms, to its actual present value terms of 0.517.
I got that.
Yeah. So let me explain this in another way. This what happened here. The 0.1 million perpetuity begins in year 16. Okay, so when we multiply by 1/r, year 15 is its present. The result that we get by multiplying 0.1 into 1/7% is in the timeline for that figure, year 15 is its 0. So that cash flow is now at year 15. And that value is that for that 0. Now, our 0 is different. Our 0 is another 15 years behind. Today, our 0 is today. Our 0 is not in 15 years, which is why we discount it back further by another 15 years by multiplying that figure by the discounting factor. So what you see here, the perpetuity factor of 7% into the discounting factor year 15, you get 0.517. Finally, you get 109. Actually, here you can't avoid it. You'll have to do that calculation. So sum this, sum this, therefore going on. Okay, there we go. 109.2787. Is everybody clear on this? This and this. That's it. In terms of the cash flow behavior, this is the most complicated picture you can get. We can complicate it a little further. But so far, what are the concerns you have with this? Anything that you don't understand? Especially with this. And I hope the negatives are very clear. It is not a very, don't confuse it too much. If we are spending money, if we are putting our money to the project, if we are investing, it's a negative. It's a cash outflow. That is why I have taken the 218 here under cash outflows. Anything that we are generating from the project, anything that is coming in is a cash inflow. This is the long form table of this calculation. This is the straight up way of getting this done. Any concerns?
So could you share this slide with us?
As in the Excel?
Yeah.
The Excel?
Or is it necessary? I don't know. It's fine because you're recording it anyway. It's okay.
No. I didn't I share it? I share it, no? I do share it. I will share it. Okay, all right. So if that is the case, if you are clear on this for now, there are plenty of sums you can try. Okay, in this, and then now you can go back to your study guide. You can start working on those examples in the study guide. And next week we will introduce investment appraisal scenarios, capital rationing, unequal projects, lifetimes of like comparing projects with different life cycles. So you have several examples in your study guide. Try them out, work them out, calculate, read through them. Perpetuity, annuity, everything's addressed, and that's it. But I think what we've done here is more specific and more detailed. So you can work on that. There are plenty of examples for you to try as well. Yeah, so one of the things that, if you remember, I touched on when I looked at last week's session is my explanation on the advance payments and the arrears payments. Arrears and advance. So for example, here, what has happened is, and the arrears and the advance usage. Now in this sum, when I quoted the figure to you, I told you another capital investment is made at the beginning of the 10th year. It's an advance payment for the 10th year perspective, right? For 10th year, it's an advance payment. And where do advance payments belong to? For the 10th year, advance means it's at year 9. For 15th year, advance means it's at year 14, end of the year 14, because that's how we have developed the, unfortunately, we have developed the, or fortunately, we have developed the present value tables. Okay, you can have a different present value table, but the table that we have developed is anyway from the point of reference of 0, which is today. So it goes annually, year by year, which is why we work it out this way. So there can be advanced and delayed annuities and perpetuities. Now here I took a delayed annuity. This is a delayed annuity where the annuity is not starting from year 1, but it's starting from year 4. I can also start an annuity immediately. So you're investing the money, but you're also immediately starting to make a return because your payments are in advance. There can be investments like that. So then this 5 will get pushed up. The 5 will be at 0. So you have to be very cautious about the timelines. So try these examples, right? Play around with the annual, the advance and the arrears behavior of payments. Use this sum that we did as the point of reference. Calculate, do the rest of the numbers also. I'll quickly I'll give you the answers next week. Go through the discussions on IRR. We already looked at it. I showed you this behavior in the graph that we came up with also. You see the same kind of pattern. We know what the IRR is. And ideally, another thing that I want to add to IRR is that IRR is also the maximum percentage rate of return that is either expected from a investment or that can be borne as the cost. Because the moment it goes beyond, the cost of capital goes more than the relevant number, whatever IRR is, the NPV becomes minus. What has happened here? Okay, anyway, right? So slight deviation here. There we go. Okay, so the moment your cost of capital goes more than the IRR, you will notice the return line is now in the negative NPV side. So that is why we say IRR is the maximum you can push. If you push it further, the cost of capital or the rate of return that you're trying to chunk, if the bank increases their expectation up more than the limit that you can bear, So let's say your IRR, you're the company, you're the investment, I'm the bank. I have lent you money. And for you, you have calculated the IRR, it's 12%. Currently, the interest rate is 8%. So you can bear it because you're making additional money than what you have to service to me. Because my interest rate is 8%, your IRR is 12%. But if I say next year, look, from this point onwards, my interest rate is 15%. Now we have come here. We are venturing into the place where my expectation exceeds your maximum bearability, exceeds your maximum percentage rate of return that you can bear. So if your IRR is 12% and I'm asking for 15%, now suddenly the project is non-viable for you because in excess of what you're making, you have to service to me. You have to give it to me. And not as a return also. It's servicing cost, finance cost, cost of capital. That is a tricky place to be in. So IRR, another definition, not just the cost of capital where NPV is 0, but it is also the maximum percentage rate of return that a company can bear to pay a certain lender or an equity owner or a shareholder. Cost of equity, cost of debt, everything's the same. So we discussed, this is critical, guys. We built the foundation for almost 60% of your syllabus today. Go through these numbers, well, rework them. Spending time on these basics, more time, why I'm taking it slow and why I did want to spend a good time here is because I want them to be, you have to be very clear and you have to be in a position to someday teach it to somebody else, share it with someone else. And given that you guys are in a finance background, you're in corporate finance, you have corporate finance aspirations and research aspirations, these are important. You will use them down the line. So remembering them can always be very useful. And even if you become billionaires and you start investing your own money, these are the basics you will work with. You will have annuities, perpetuities, etc., etc. You will take into account the inflation effect, and that will be done through the compound interest formula, etc., etc. Right? So once you do that, once just be very comfortable with all this, so we can go into investment appraisal 2, part 2 next week, where we now start really dealing with complications and various scenarios related to project appraisal. Right. So on that note, I'm going to wrap things up for today. Any last thoughts and questions? All good?
Yeah.
Yes, sir, all good.
Then I think we can finish things off. Stay chill and stay safe. And God bless, guys. I'll see you next time. And Rushda,
Thank you, sir.
please don't forget my
Yeah,
favorite.
I'll do it.
Thank you. Thank you. All the best, guys. Take care.
Thank you.
Thank you, sir. Bye.
Thank you, sir.